Good morning, everyone. This is Nick Ryder, Chief Investment Officer here at Kathmere Capital Management. It has certainly been an eventful last few weeks, not only in the markets and the economy, but I'm sure in many of your professional as well as personal life. I hope that everyone is being safe at this time. In today's webinar, wanted to get everybody together quickly to spend 20 or so minutes. Two main objectives today. We want to provide an update on where things stand in the markets and the economy today after a certainly volatile few weeks. And also then, secondly, share some historical perspective to show that or demonstrate that markets have overcome adversity like this before. We have confidence in the stability of the long run and believe that investing will continue to bear rewards for long-term disciplined investors. We'll start here on the first slide, which is just going to provide a very brief snapshot of what's happened to the U.S. stock market, here represented by the S&P 500 index. And as many of you are likely well aware, we've experienced a rather sharp and rapid fall over the last now less than a month since the S&P closed at an all-time high on February 19th. We've seen markets decline by nearly 30% as of yesterday's close to 2386. This has certainly been a jarring decline for many, and it's completely natural to feel unsettled by such a decline. These things happen, as we'll demonstrate in time, but not that frequently. Also particularly unsettling or potentially unusual about this specific decline is two additional factors. One, the speed at which we've seen this 30% decline is somewhat unprecedented. And secondly, and very relatedly, is the daily volatility that's accompanied it along the way, particularly over the last 2 weeks now. What we show here on the second slide is just looking at providing some light on how quickly or how unusual the speed of which the market has declined from an all-time high to being down more than 20%. So what we've looked at here is going back to the beginning of 1928. This now marks the 11th time that the S&P has declined by 20% or more from an all-time high during the 93-year period. And what's been remarkable, as I mentioned, is just the swiftness with which we've fallen from an all-time high down into what's called bear market territory, or signified by that 20% or more drop. And what we can see is that in the most recent event, it's been 22 calendar days it took from February 19th to March 12th for the market to drop by 20% from that all-time high. And you can see, just looking at the right-hand side of the screen, this is really only rivaled by two different instances in the past. So during the fall of 1929, really at the onset of the Great Depression, the decline took a little over a month. Similarly, during the early fall of 1987, the market took 55 days to drop from an all-time high. Of course, that was aided, as many are well aware there, on October 19th by a 20% fall. So really, this is somewhat of an unusual circumstance. It's totally natural for investors to be potentially caught off guard by the speed at which we declined. As famed investor, I read a quote the other day which I thought perfectly summed up the situation. Howard Marks, famed investor, founder of Oak Tree Capital Management, I think he put it perfectly when he described the situation as an extreme reaction to an extreme event compressed into a very short period of time. The other part of it that we look at, and highly related, obviously you can't fall quickly without having a number of large moves in a short period of time, which is just the remarkable volatility we've seen in the S&P on a daily basis over the last now month. So I go back here, we present all the way on the left-hand side of the screen, February 19th, where we saw the markets closed up about 0.5%, closing at that all-time high. Since that period, it's been a number of days in the red and pretty significant ones as well. So what we see there on the chart is that 12 of the last 16 trading days have seen the market either gain or lose, unfortunately lose more often than gain, by 3% or more. To put this in contrast, and this is a particularly stark contrast relative to the experience we've seen over the better part of the last, call it 5+ years. In fact, during the prior 8 years, from 2012 to through the end of 2019, we only saw 11 days in which the market gained or lost by more than 3. So to compress a greater volume of those types of days in a short period of time after a period of relative calm is certainly jarring for all investors. Important, additionally, as many have seen in the headlines, we've experienced a number of historical days. In fact, we've seen 2 of the worst 8 days in the S&P's history. One coming just yesterday with the over 10 with the 12% decline, as well as in what we saw last Thursday with the 9.5% drop on the 12th. But we've also seen, as is typical in highly volatile periods like this, there you have on last Friday on the 13th, we saw what's the 12th best day in the market's history. And this is something that's pretty common during volatile drawdown periods. 2008, around 1987, as well as going back to the volatile periods in the 20s and 30s, you have what's called or typically referred to as volatility clusters, which is as market participants, whether it's long-term investors, short-term traders, try to digest a rapidly evolving situation. Markets have been prone to large moves both up and down that tend to coincide with one another. Something that's really not unprecedented, unfortunately, for many investors is, and this is something we've talked to many of you about in multiple occasions, which is that a 25 or even 30% drawdown from an all-time high is not unprecedented in market history. It's something that I refer to as quote unquote price of admission for long-term investors seeking to capture the stock market's incredible long-term gains, so to the tune of 10+% a year, that we have to go into it full well knowing that 25-30% drawdowns are going to be a normal part of our investing experience, unfortunately. What we see here on the chart, again, going back all the way to the beginning of 1928, is that this now marks the 9th drawdown of 25% or more from an all-time high. You do the math on that, that's 9 of them in roughly 93 years of period. That's 1 every 10 or so years. So for a long-term investor, you were likely experience a handful of these in your investing careers. I know yesterday we closed down, we showed the number slightly more than 29% from the all-time high. We're a little bit up off of that today. But if we do breach that 30% threshold, this would become the 7th drawdown of that magnitude from an all-time high. So again, not quite as frequent as the 25, but still something that happens once every 13 or so years. This is ultimately why, as many of you know, in your experience in working with us in your advisory team, this is why we spend so much time ensuring your portfolio is properly calibrated, not only to your goals and objectives, but also your ability to take risk, i.e. your ability to have the portfolio sustain the spending rates you need, as well as, and importantly, your psychological or emotional willingness to kind of bear that risk. This is why we spend so much time up front trying to understand you, your goals, your objectives, that your willingness and ability to take that risk. Make sure portfolio, and many of you can, or all of you can rest assured knowing that the hard work has been done up front. We've prepared and thought about the fact that scenarios like this were likely to occur during your investing period. And this is an unfortunate reality of long-term investing, but one that all you should rest assured that you are prepared for, and that it's something that has been accounted for when your investment plan has been developed. So knowing that we've had a 25% decline, we thought it would be helpful to now share here how have markets fared historically following the breaching of that 25% drop down threshold from the all-time high. So what I look at here on the slide is we examine the 8 prior instances in which the market was down by 25% or more from that all-time high. We mark the date there. You can see them all along kind of the left center side of the page. And then we follow the market and see how the S&P 500 did over the following, what's represented here as 1, 2, 3, and 5 years. So these are trading days that are demonstrated. So on average, over the last 90 plus years, we've seen about 250 trading days in a given year. So you can think of as these numbers as representing 1, 2, 3, and 5 years respectively as you move from left to right on the page. And what you can see, by and large, we summarized the results there at the bottom, showing medians for these eight instances, as well as the individual instances itemized each. But you can see that markets have historically recovered quite well following following these drawdowns. You can see that on average, they're looking at the median towards the bottom part of the page. A year after crossing that 25% threshold, markets have been up by about a little bit more than 11%. You extend the clock and look forward 2 years after the drawdown threshold is closed. On average, across these instances, we've seen the market up by nearly 25% and kind of hold steady and continue to marginally increase beyond that as you look out to the 3 and 5 year mileposts. As is the case with pretty much any market analysis, you're going to do the Great Depression naturally stands out there as an outlier to all of this. You can see Great Depression, certainly a beast of its own. Excluding that, we show the median analysis excluding 1929. You can see results become even more impressive. The gains have been even more strong and rapid following this decline. You've seen a year later after the decline up more than 20%, up close to 40% if you look out 3 years after the fact, and a little bit more than that 5 years after the fact. Bottom line is on all this, the markets have, as we say, have rewarded discipline. Those that have had the wherewithal to what we would say, describe as stay the course, stick to their plan, have been rewarded with impressive market gains following experiencing these short declines. The other part I want to just cover here, and this is very highly related to that last slide, which is, a lot of, understandably, there have been lots of concerns talk in the media about the economy heading into the recession as a result of the actions being taken to curtail or contain the spread of the coronavirus. Here, what we look at is examining the last 10 recessions that are experienced in the U.S. economy dating back to the 1950s, and you can see arrayed there on the left-hand side of the page, you see the economic peak, which is the start of each recession, the trough, which would then be the beginning of the recovery. And we then present the fourth column in there is how has the S&P 500 performed during the recession? And you can see that perhaps many of you are going to be surprised to see there at the bottom, the median experience has been, the S&P has been roughly flat to slightly up during the recession. Of course, there's a pretty significant degree of variability in there. However, you do see is that during the actual period, which is a recession, markets have been flat. Why is this the case? Well, it's because markets by nature are forward-looking. So each and every day when trades happen, when somebody sells to a buyer and a buyer buys from a seller, both of them are imparting their knowledge and expectations of how the future will unfold into market prices. Market, as we say, it leads the economy. So what you can see in 9 out of the 10 instances, I'll say the 2001 experience was a slight wrinkle to the rule here, but in 9 out of the 10 experience, we followed the exact same sequence, which is that the market peaks. It leads the economy by about 7 months on average. We'll have a market peak. Market starts to turn down. The economy 7 months later is officially declared as moving into a recession. The market then troughs a few months thereafter that. Market hits bottom and begins its recovery during the recession, and then subsequently about so the markets on average, you've seen the economy trough and the expansion then begin to take hold. So importantly, what I do want to look at here, the far right side, of course, which is that you see on average markets have declined by about 24% in and around the recessionary period. So this is simply looking at market peak to trough. Of course, we've exceeded that by a little bit here. And of course, you've seen some experiences where the markets have declined by 50 or so. You've also seen a handful of experiences where the drawdown has been even more muted. What we've seen, you can see actually 4 separate instances there where the markets declined by less than 20. In fact, 5 of the 10 instances the markets declined by less than 25. But I do want to stress here again the forward-looking nature of markets. Undoubtedly, the economic scenario is likely to begin to look worse as we move forward. The drastic actions taken to curtail the spread of the virus are anticipated by the market. In fact, the low drawdowns of the last 20 or so days, the 30% off, has been trying to account for the fact that markets will, or the economy is going to deteriorate in the months ahead. You're likely to see an unemployment rate rise, retail sales and construction or industrial spending decline, GDP figures eventually will decline as well. The important part is that the markets are trying to price that all in right now. So as the bad news unfolds in the months ahead, as it relates to the economy, the question isn't necessarily whether it's good or bad news. It's simply whether or not the results or the economic impact or the impact on corporate profitability is coming in better or worse than anticipated. And that's something that will just have to unfold over time. If history is any guide, though, we do believe that markets will kind of lead the economy in this. And that while the worst may be yet to come for the economy, markets, that remains very much an unknown. Lastly, I do just want to share this little bit of what I'll call silver lining to the recent declines in the market, and provide further hope for the future as it relates to stock market performance. And what we see here is that, simply put, valuations on the U.S. stock market or the S&P 500 are substantially more attractive today than they were a month ago. That's not a surprise when you have something go on sale by 30% that it becomes cheaper. But what we see here in what I plot is what's called the Shiller PE, or the Shiller cyclically adjusted price to earnings ratio. It's a little different than the one many of you may see if you're reading the paper or seeing on CNBC. What this does is it takes the price as of today and it compares it to the average earnings over the last 10 years. A lot of the typical metrics which you'd see would compare the price today versus the earnings over the last year or the earnings estimated by analysts over the next year. This takes out a little bit of the noise and some of the noise and randomness that can happen to two of those metrics, which by smoothing over a longer period of time, you get what would be considered as more representative of the full economic capacity or earnings capacity of companies. And it's also importantly not subject to estimates of the future by analysts, which could be revised sharply higher or lower as events occur. This is really probably my preferred valuation metric, and the reason being is that from an analytical perspective, it's done a very good job at forecasting what I'll call intermediate to long range stock market returns. So think in the 7 to 10 year horizon. The starting valuation level on this metric has done a good job at explaining about 50% of the variation of 7 to 10 year forward equity market returns. What we've seen is cheaper, lower valuations have been associated with stronger forward returns, and higher, more expensive valuations have been associated with weaker returns going forward. And you can see that kind of coming into this year and preceding this latest draw-off, valuation ratios were towards the higher end of their long-term averages, really only preceded in a couple different instances. Now that ratio has declined down to 22.3 times using yesterday's closing price. And what you can see highlighted there on the page is that we're now substantially cheaper than the average over the last 25 years, which has been 27.3. And we're rapidly approaching the valuation average over the last 50 years, dating all the way back to 1970. What this tells us is there's reason for optimism that in the, call it now 7 to 10 years ahead, stock market returns can be are much more likely to resemble long-term averages, whereas going into this year, as a result of high valuations, it would have been reasonable for investors to expect lower than average returns in the years ahead. Now I think those numbers have certainly improved in investors' favor. Of course, looking forward in the weeks ahead, months ahead, even years ahead, it's anyone's guess what's going to happen or how events are going to unfold and how the market's going to react. I can come up with a strong bullish case, in which case world takes the coronavirus threat seriously. Tests are made widely available. You have citizens adhering to self-quarantine, adhering to social distancing guidelines to really contain the spread. You'll see governments effectively administer monetary policies. We're already seeing the Fed do that. We could see fiscal policy on the side of Congress and governments around the world. What you would ultimately hope to see is infection rate peaking soon. Hospitals able to manage the load of people coming in. Death will ultimately be mild. Treatments, vaccinations made widely available, and we get a self-immunity up to this. If that were to all unfold, a very strong bullish case could be made that markets and economy could recover very sharply. Right. The flip side of this, the bear case, is the threat's not taken seriously enough. We're unable to develop the tests or vaccinations that are required. Hospitals aren't able to manage the load, and the drawdown and the draw out of this viral spread continues and it's prolonged far longer than it needs to be. This could ultimately put the economy into a prolonged slump. Valuation rate metrics, the markets could continue to fall. That's not our base case, but it's certainly a bear case. I think somewhere in between the bull and the bear case is the reasonable expectation for what could unfold. All that said, I don't have a strong sense on what that will look. I don't believe anybody does have a clear sense on exactly how the events will unfold. What I do know, what I can say with a pretty significant degree of confidence, and relying on history as a guide here, is that I strongly believe that investors who stay the course, stick to their plan, and who use their long-term time horizons to their advantage will be rewarded as they have been in the past. We think markets will eventually recover. The U.S. economy has been through a number of crises and travails over the years, and it has recovered. To that point, I'm going to close with a passage from Warren Buffett, the greatest investor that there ever was. In his letter to the shareholders of Berkshire Hathaway, written in February 2009, during the depths of the global financial crisis, Buffett shared his perspective on state of the economy at the time, and he articulated, I thought beautifully, his sense of optimism for the future. In the letter specifically, here's what he said. He said, "Amid this bad news, however, never forget that our country has faced far worse travails in the past. In the 20th century alone, we dealt with 2 great wars, one of which we initially appeared to be losing, a dozen or so panics and recessions, virulent inflation that led to a 21.5% prime rate in 1980, and the Great Depression of the 1930s, when unemployment ranged between 15 and 25% for many years. America has had no shortage of challenges. Without fail, however, we've overcome them." He continues on to say, "America's best days lie ahead." I believe those words ring true today as they did 11 years ago. Thank you all for your time this morning and the trust you place with us every day. Please don't hesitate to reach out, give us a call, send us an email if you have any questions on this, want to talk about your personal situation, more of any commentaries or other additional comments on today's webinar or otherwise. In the meantime, everybody please be safe, and we look forward to talking to you soon.